Upgrading PVH to overweight, downgrading Bath & Body Works and Foot Locker to underweight. Let's bring in Matthew Boss, JPMorgan's retail analyst. Matt, what a pleasure to talk to you again. Good morning.
Thanks, Carl. Great to be back.
We showed the mystery chart before the break. Talk about why the PVH upgrade.
Look, our focus right now is on self-help as well as value and convenience. I think that's your playbook for 2024, in that I think the macro will continue to be volatile. PVH trading at a trough valuation. They, in my opinion, both the Calvin and Tommy brands are set for the foundational changes that really have been in place for the last 3 years. Now you have the operational improvement, the supply chain is intact, you've made material new hires, particularly on the supply chain. So the risk reward, in our opinion, given that this stock is trading at a trough multiple, particularly into cost saves in the fourth quarter and costing opportunity as you move into the spring, I think there's 200 basis points of margin upside relative to consensus as you look at the 2024 numbers, and that's hard to come by in the retail space right now.
In terms of global brands, you're still overweight Ralph and Nike. You're still overweight Lulu, but you do remove Lulu from the focus list. Are you getting more cautious at the margin on the high end as well?
No, so the way we're kind of thinking about it and sticking with that self-help theme, obviously some of the issues that Nike has gone through over the last 2 years now become opportunity on the other side. I think the total addressable market for active and athletic favors a Nike as well as a Lulu as we move coming out of the pandemic, where I think the brand awareness and health awareness coming out of the pandemic is stronger, as well as the casualization trend, which in my opinion is the mega trend post-pandemic. So I think Lulu and Nike both set up well in that. More self-help at Nike as you think about the 2024 and 2025 playbook, but still early innings growth on Lulu. It's just performed at the top of our list as an overweight, so we do remove it from our best ideas list and focus more on self-help, as you said, upgrading PVH with Nike and Ralph, both being self-help opportunities as we move into next year that can buck the trend with a macro backdrop. Particularly, it's more that low and middle income consumer that I think is where the real exposure is.
Matt, you don't think that Foot Locker is a self-help story? I noticed you downgraded the name, which, look, it's already had a pretty big move lower. Everyone was so excited for Mary Dillon to come in and fix some of the relationships and turn around this stock. Why the downgrade?
Yeah, hey, Sarah. Look, our focus is on the E and the fundamentals. And breaking down this model, we're 30% below the street for next year. So, look, while I'd love to find a reason to be constructive and buck the trend like we're doing on PVH, to me, the fundamental setup into next year, I do think it points to sequential improvement, but with same-store sales down nearly 10 at Foot Locker, there's a number of issues that, look, the new team is working to fix, but the partnership reset with Nike, as well as competition in the space, I think right now is very fierce, as well as an extremely high concentration of low to middle income shoppers, which I think into next year, that is not the concentration you're looking for. That's also part of our downgrade of Bath & Body as well. I think the reality is it comes down to pricing power. It's differentiation, innovation, and taking market share. And that's really where our overweight ratings as we move into 24 are paramount versus others that I think need a level of macro. And that's where, in my opinion, a Foot Locker and a Bath & Body Works fit in, which is the premise behind our downgrade on those two today.
Right. I noticed you're still underweight DG and Big. We've talked about this before. Why, in an environment where there's macro pressure, especially at the low end, does the dollar concept not work as well?
Yeah, it's a great question, Carl, because you'd say historically, with economic disruption, you would see the trade down opportunity. And the two sectors would be off-price, which would be TJX, Ross stores in Burlington, as well as the dollar stores, Dollar General, Dollar Tree. The difference today, it's twofold. One, you're battling the inflationary pressures and that pressure point on the low to middle income consumer. But the bigger is convenience. I mean, I've been a broken record on this show talking about value and convenience. That's what matters to that low to middle income consumer. Walmart, Target, the discounters, the grocers, they've invested a tremendous amount of money over the last 5 years to be more convenient. Technology battling up against the e-commerce retailers. I think that the small box retailers, the dollar stores, have lost a step on this convenience element, which means there's an increased battle on value, which translates to margin compression. So our view is for value and convenience, it's off price. I love TJX and Ross Stores. I think that what they're doing, they're bringing top known brands to the consumer at great values. And I think that's the way to win in 24 and 25.